Okay.
Okay.
I did the string.
I'm seeing something is changing. Let me see. Okay, perfect. Yeah, it's working. So I'm gonna switch off the camera until it's time.
Okay, sure.
And perfect. All good. Actually, sorry, I forgot to ask. Can you screen share like a YouTube video of a 10-minute countdown and just let that play until we start? Otherwise, the people will get confused. You can literally just go to YouTube, search for a 10-minute countdown, and just full screen and screen share it, and then it will just play in the stream.
Now?
Yes.
Okay. think we're going to start in 1 minute. So, thank you very much, and welcome to another insightful session in the Risk Awareness Week. So, and we honored to be welcomed by Alex Sidorenko. Thank you very much, Alex, for believing in the Risk Leaders Initiative and letting us join and hear from your insights. To start with, Alex, in your experience, why do so many leaders still see risk management as a reporting burden instead of strategic tool?
Thank you. And welcome everybody. Today I'm a guest on Fayyad's show, but we are both guests on Risk Awareness Week because we are broadcasting into different platforms. And if you are online with us now, you can ask questions in writing or using whatever the typical procedure is. And if you're watching in the Risk Awareness Week, you know to ask the questions in the comments, and I'll try to respond to that. So today we will kind of do back and forth in the interview format, mainly because I didn't have time to prepare slides. But it still, I promise, will be very practical, valuable, and entertaining. So the first question is, why do risk leaders still kind of waste opportunity to make a valuable contribution to the organization? I think there are like three possible answers because it's individual in every case. Large proportion is that many risk managers think that ISO 31000 and COSA ERM is all there is to risk management. They don't recognize that both of these standards are nothing short but an executive summary of the actual underlying sciences that is behind risk management, the decision science, the probability theory, the behavioral economics, operations research, and all sorts of other fields that are associated with risk-based decision-making, risk-taking, risk management. And so I think a majority of risk managers think that risk management is what the standards say it is, and it's not even close. Like, it's not even the tip of the iceberg. So they genuinely believe that what they're doing is aligned with the standard, and as a result is the kind of the maximum value you can extract from risk management. Because I suspect most of them are kind of not really comfortable with the value they generate compared to head of strategy or head of investment or head of procurement or head of or CFO. These executives provide a lot more value to the organization. So I think deep inside, risk leaders kind of uncomfortable, but they also don't realize that there's a lot more value to give. So that's the majority of the people, and a small proportion is risk managers kind of hoping for an easy, relaxed life, not willing to take ownership of some of the risks. And I mean, this again sounds crazy, but I strongly believe risk managers need to own certain risks and take full responsibility for them. So some are kind of just retirement age. They don't want to do too much work, which is again understandable, but you kind of, that's not normal. Like we shouldn't be using that as a role model. And then there's the last bit, the percentage of people that came into risk management from accounting, sometimes legal, sometimes compliance roles, and they just don't understand the basic math of risk management. They just have no grasp of what is a probability distribution, or what is uncertainty, and how to measure that. So they sometimes genuinely or hiding their kind of ignorance or incompetence, they just don't do what is required to be done for risk management, because they never had the skills. And I know a lot of senior risk leaders that are not quants themselves, but they I think are visionary enough to hire somebody in their team to do the quant side, because you only need like one mathematician to have a proper risk department. And now with AI, it's even easier. But yeah, there are plenty of risk leaders that not only never had the competency to be risk leaders in the first place, they also don't kind of recognize that gap in knowledge. They don't hire somebody in their team to have the skill. So I think across these three reasons, that's a pretty good guess on why we're still not extracting the value we should be extracting.
Great. And even, Alex, what scares me the most is, even if us not analyzing the uncertainty before business decisions, who does, right? So how the organization is making decisions considering their uncertainty, what are they using?
Yeah, and the answer
it's
to that,
scary.
well, yeah, because the answer to that is actually crystal clear. I've across multiple organizations, I've tested the hypothesis that surely somebody is thinking about risks and properly analyzing and quantifying and accounting for risks when signing contracts, approving projects, and the general conclusion is that they do to a very small degree. Business at the moment, in general, unless the risk manager kind of steps into the process of approving something or signing something or preparing a project, an investment or a contract or a I don't know, some sort of decision for the board, it will almost be random. Like some risks will obviously be picked up because it will, instead of becoming like a systematic process where you go through the cycle of trying to challenge different assumptions, trying to stress test the assumptions, trying to quantify the uncertainty and effect it has on the decision, and try to find the kind of the optimum trade-off between risk and reward. Without doing that, you're literally falling back onto this intuitive random risk identification, where one executive used to work in tax firm, so he's really switched on the tax risks, so he will bring his experience and kind of pick up on the tax risks. But then if in another organization there was nobody that from the decision circle that worked in the tax specifically, that means the tax risk will be completely ignored because they just they're not top of mind. So it becomes this almost like a random guess game, where if you're lucky, most of the risks will be picked up by accident. If you're not lucky, then the company absorbs the risks. And to everyone listening to us, you have no idea how much your companies are absorbing risk today. It is like, it's genuinely scary if you actually dig deep into any meaningful decision that happened over the last few years, you would be amazed how much unnecessary risk the company is taking in that. And to kind of to put a positive spin on this, because I think this is where the value is, and kind of ultimately what our topic of the conversation today is, that we don't have to continue down that path just because other organizations or other risk teams choose not to be involved in the decision making, choose to not participate in planning, budgeting, forecasting, project management, and so on. If we do that, the value will become so immediately obvious and so tangible that it will really differentiate us from other risk professionals. Because the bar is so low, anybody who does like 5 seconds of quantitative risk analysis attached to some important decision is already a top star. Like that's the world we live in. It's so easy to be exceptional at risk management today, just because everybody else is wasting the opportunity to kind of to get involved, and the people that do get involved, they immediately see the kind of the change in I don't know what the word I'm looking for. Like it's not respect, but just the role that they play in the organization. Their role changes.
Yeah, great. So I think, Alex, you've shown us that risk insight can really deliver real measurable savings. So what can you say around this?
So this is kind of ultimately the main topic of our conversation, and we have we have so many examples, and I'll try to cover 5, 6 different ones. I want to kind of set the scene first. Is we have to kind of appreciate that the base at which we're starting with is very low, and typically the way decisions, the way business plans, the way budgets, the way investment proposals, contracts, negotiations, project schedules, the way most things are done in the organization today is deterministic, which means whoever makes that decision, whoever prepares that decision, they pick a single scenario, and that scenario usually is translating into everything will go fine according to plan. So they pick one scenario where everything should just work as intended, and then they build everything around that. And it could be signing a sales contract, and in the sales contract you put in your product characteristics that would be acceptable to the client, and you make them overly optimistic. You ignore the fact that sometimes your products may not be as high quality. Maybe there's some sort of mixed things that change the composition of the chemistry of the product. Maybe I don't know, some tests are passed 80% of the time instead of 90% of the time, or 95% of the time as you intend. So it's important to understand that anywhere you look, like literally just go into your office tomorrow, look around, speak to any of your department heads, friends, and what you'll discover is that most of the assumptions are made either based on averages or even worse, it's not even based on averages, it's based on like a best case scenario. So we will have this equipment delivered in 6 months. And when was the last time? Because that's what the manufacturer tells us. It's the 6 months. But when was the last time we were actually able to deliver it in 6 months? Well, never, because it's always some delay. But we will use 6 months. So maybe what's even worse, when it's not completely unrealistic, it looks realistic. But then when you do the investigation, you discover that we've actually delivered in 6 months only once in the last 3 years. And that means it's like the 3% chance that this will be delivered in 6 months, and then like 97% chance that it will take longer. But we've already built our business plan and our project schedule around this one, optimistic forecast. So the big caveat is that the world we live in, the business world we live in, even in our personal lives, it's all deterministic, which means we try to pick one version of the future, and then we commit to it, and then we believe in it. And I call it the trading view versus risk management view. The trader, they try to guess the future and then commit to that version of the future that they've guessed. The risk manager doesn't want to commit to any version of the future because they realize that there's a lot of uncertainty in assumptions, that there's a lot of volatility in how things may turn out. Maybe it will be 6 months, maybe it will be 8 months, maybe it will be 18 months in the worst case scenario where the engine is almost delivered, but then the truck overturns and the engine drops in the river. So there are a lot of alternative scenarios that most organizations simply ignore, and risk managers are kind of trying to bring that uncertainty back. And this is a big revelation, because once you accept and appreciate that the business is deterministic, well, the business is pretending to be deterministic, but the reality is stochastic. Stochastic meaning that every single assumption that we make, every single forecast is actually a range. And the less we know, the bigger the range. The more we know, the smaller the range, but there's never any certainty. There's never any certainty in business. And with that realization, you literally look around and you go, okay, where's our company losing money? So the easiest example is in sales. Usually when you look at sales and you start talking to the sales team and to the finance team and to accounts receivables team, you discover that every year the company has to write off millions of dollars usually, because they sold to customers that delivered product to customers that never paid or didn't pay in full or went bankrupt and couldn't pay. So and that's the plain vanilla credit risk that banks have managed to figure out so well. And in non-financial services, we have exactly the same problem, and we have Treasury taking care of that risk typically in finance, and risk managers not really getting involved, which is a big mistake, because last time I looked at the methodology that the Treasury was using to quantify that risk and to make conclusions and to prioritize customers based on that risk, to figure out if they will accept advanced payments, how much credit line they can offer to all of these clients. When I started working and discussing, when I deep dived into this risk with the procurement team, the Treasury team, it immediately became obvious that we were just wasting money, because we were not even not even advanced approach that the banks use. We were not even doing the basic approach that the banks were using. So that's an opportunity, just sitting on the surface, where ask your finance, how much money, what are we losing the most money on, and then find out who the owners of the process are, find out what the relevant procedures and methodologies are. And then just backtest some of the calculations and propose a better methodology for managing that specific risk. And you would be amazed that within a year you can show a tangible reduction in risk exposure and in risk and in actual losses. So last year we had to write off 15 million. This year we have to write off 5 million. That's a very direct, tangible savings from better managing a particular risk. Maybe what you would normally discover is that maybe the accounting system needs to change because it's actually not properly tracking. Maybe you need to come up with a methodology where the credit rating or the credit score for key customers needs to be adjusted. We basically, when we did this many years ago, we actually ended up rewriting the whole methodology, like every single word, rewriting the whole methodology, rewriting the whole customer scoring methodology, the rewriting management reporting, so we could actually track credit VAR in advance and kind of preempt how much write-offs we would need, and take action. The product managers started taking action. So that's one very simple example on how to deal with it. And again, AI can now explain how the methodology can be improved. With the caveat that specialized risk management AIs significantly outperform the public LLMs, because public LLMs are all risk management one. What I call, so they give you the textbook ERM response, not necessarily the useful decision making response. But once you overcome that hurdle, you can then use AI to help you figure out where the gaps are in methodology and how to improve it. Or you can, just find somebody within the treasury who is mathematical enough, again, which is not a problem. Most treasuries have some sort of FRM certified professionals. Find somebody within treasury, or just bring in secondment or hire somebody. Any quant can do credit risk management in his sleep. It's like it's a pretty easy risk to deal with, because it's been well researched and well documented. So that's one easy tangible example.
Thank you very much, Alex. So what's usually like sort of the first practical step risk team should take to make their insights part of daily decision making?
So, sorry, can you try paraphrasing the question, please?
So what do you think the first practical step that our audience as risk leaders can take to make their insights part of decision making?
Yeah. So well, I want to give more examples on where we can save money, because credit risk is just like one tiny piece. That there are many others. Because in answering your question, is the risk manager can talk to finance, to whoever is their friend in finance, whoever is their friend in whoever's preparing management reporting, and just find where the company is losing money, because that's essentially where the risk manager needs to go. The other things that we looked at is when we were analyzing our production forecasts and our production performance, how much volume of product we can generate to then sell that. What we also found is that the production had quite a lot of volatility. So one day it was producing a lot, then some sort of breakdown happened, then there was like this back and forth. Then they're trying to catch up, and so the annual production volume is the same. But when you look inside, and this is what happens every single time, because the businesses think they're deterministic, but in reality everything is stochastic. When you look inside, you actually see that there is this big volatility in the months, but then when you look inside each month, there's big volatility in the day, and then when you look inside the day, volatility inside the hours. What you basically discover is that production facilities have lots of unplanned downtimes. When something breaks down, they have to stop, they have to fix it. And then they start immediately trying to catch up, because they have the annual target and it's probably linked to their performance bonus. So it's a double risk, because not only it breaks down for some reason, but then they're trying to catch up. So they're trying to produce more than the equipment was intended to do. So now they stress the equipment, increasing the future risk. And this vicious cycle is non-stop. And understanding why that happens, what is the nature of the underlying risk, what are the operational risks that cause that volatility, and trying to discover the methodology. Well, first create the methodology to kind of to capture that volatility, to understand whether it's significant or not, but then work with the operational team to reduce that volatility. Is again has a direct and immediate impact on the volume of product produced. It's much more stable, it's much safer, and it leads to better forecasting. So that's a second example. So on the answering your question, where to start is wherever your company is losing money, and the second, it's basically like it's two prerequisites. Whatever the company is losing money, and then the second prerequisite is whoever is your friend, because you don't want to. Sometimes I have good relationship with the head of strategy. Sometimes the head of strategy is the most difficult person to deal with because they're very in their own world. I've been very lucky kind of over the last two places I've worked with. But sometimes it's just difficult to find the connection, and so you don't go with your pilot project to somebody who is difficult to work. You just find friends that you have common ground with, and I always found common ground with head of investment, and then you're trying to understand, okay, what are the what are the kind of the pain points that they have to deal with, where the answer may be impossible to find in the deterministic space, but may be easy to find in the stochastic space. So one example is that anybody who's been involved in the investment projects, every investment director is crazy obsessed with VAC, the weighted average cost of capital, that discount rate. Is it 9%? Is it 10%? Is it 8%? Is it 6%? Like, this is like a never-ending quest for the perfect golden egg of the discount rate. And there's no answer. Like, there's no right answer in the deterministic world, because it's a wrong question to ask. It's a wrong it's a wrong premise. There is a very easy answer in the stochastic world, and the answer is nobody cares about discount rate. Use whatever you want, because you should be putting volatility inside the cash flow, and you should be discounting the cash flows specifically based on their risk exposure. And instead of calculating NPV as a single point estimate, you should be calculating NPV as a range, and then quantifying what is the probability of achieving the target NPV or the hurdle rate, whatever the setup is for the company. So by just walking around and talking to your friends in the company, you would find so many unsolved problems that's been kind of happening for forever, because the teams that were responsible for these problems, they were solving them kind of from a completely wrong angle. They were solving them not from a risk mindset, but from an accounting mindset. And accounting doesn't have solutions for most decisions under uncertainty. So that I think is the easy first step forward.
Thank you very much. So how about the 5 proven strategies that you think it can drive financial results?
Sorry, I got distracted by reading one of the comments, to which I'll answer in a second. Can you please repeat that question? Sorry.
You want to answer the question in the comment if you want?
Sure. So Brian is asking if the risk manager can get involved in day-to-day decisions. Not clear how large a time frame is required to do proper evaluation. I don't think, Brian, that's what I'm suggesting. I'm saying there are plenty of big important decisions that can save millions by benefiting from risk management participation. Like that's a start. Let's not get ahead of us. For example, every company has lots of contracts, and every contract has a lot of risks associated with that, and every contract deserves a risk assessment. But then, I don't think we are crazy. I think we're very, very reasonable. We would say, okay, let's look at the strategic contracts first. Let's look at the big contracts first, and then see how it goes from there. Eventually, we would instead of getting involved into every single process. And I think this is where AI is going to come in useful. This is what I've done in our organization at the moment. I've built an AI agent to risk assess contracts that other departments can use. So I don't have to do it myself. They can just identify risks for the contract, literally load the contract, and the agent reads the contract and analyzes the risks, tells you, okay, here are the risks that you should be thinking about in negotiations and that should be disclosed to the tender committee and to the executive committee. So eventually, hopefully the process itself will become risk-based and the process participants will do the necessary risk steps. But let's lead by example by showing how it can be done, at least on something big and sensible. And again, like this is just it's just not an issue. At any given point in time, for a risk manager who understands their company well, I know for a fact, like we have 3 projects that require my full attention, and we have like 15 contracts that require my full attention. And it's not a mystery of if the risk manager understands the way the business operates. It's not a mystery where I should be involved. Like it's pretty crystal clear.
Thank you very much. Alex, you want to talk about the 5 proven strategies that drive real financial results. You want to talk about about that?
Sure. So I wanted to kind of to give some examples of where risk managers can save money. And number 1, I've mentioned reducing credit risk, and as the result, reducing write-offs. Like that's an easy one. As in, like, methodologically and effort-wise and cultural change-wise, it's probably not difficult. It's probably not easy. Like it takes time. But it's an obvious one to look into. If your company has a lot of diverse clients, if you're not selling to one client, if you're selling to hundreds of clients, that's guaranteed you have write-offs. That can be improved with proper risk management. Second one, if your company is producing any kind of product, you would be amazed how much money is wasted on the maintenance budget. And we're talking about like millions of dollars of waste every single year on maintenance, because maintenance is very kind of paperwork based, regulatory based. It's not always risk based, and this is it's one of those interesting things where many years ago, maybe 10 years ago, I had this hypothesis that surely the team responsible for this area is already aware of all of this. Like there's nothing new I can bring to the conversation because they've been doing their job all their life. They know what they're doing. Surely their maintenance is risk-based. Surely. And that hypothesis, I think I've kind of disproven many, many times over. So you may think that the Treasury Department should know how to handle credit risk. You may think that the operational team knows exactly what to do with operational and equipment availability and performance. But then when you start talking to them and you start discovering what's actually happening, you would soon find out that it is almost always based on some preconceived assumptions. Some of the assumptions are completely unrelated to reality, and it is the opposite of being risk-based, even when it is called risk-based, which is even ironic because in one of the European countries, the government went like full risk-based into the legislation, and they said like, oh, we're going to create every legislation that's going to be risk-based. It wasn't. And, I spent a significant amount of time with the Ministry of Economics trying to kind of, explain to them that whatever they're drafting has nothing to do with risk-based. They just didn't care. So it was a fancy term back in the day where everything was risk-based, but it never was. So there are so many opportunities there. So I've mentioned 2 bad debt write-offs, bad debts, operational product volumes, environmental fines, environmental exposure. That's another big example that we've done. Water discharge in the previous company. We actually built a very simple mathematical model that showed what are the kind of the chances of us being fined, and more importantly, losing a lot of money if the production was stopped due to some sort of water contamination and water exposure. And that simple case, that simple model allowed the environmental team, which was struggling to get the decision approved, allowed the environmental team to finally get funding for, I can't remember what it was, like a $20 million water treatment facility, which actually reduced our risk exposure from like a 200 million to a few million. So that's a clear that's a clear kind of value from risk management. But I think the most interesting part of that story is that when we put the original design of the water plant into our model, we actually showed that whatever the original design was is actually not going to reduce the risk exposure enough. So it went like from 200 million to 100 million, which is still not acceptable. And so the environmental team ended up redesigning the water treatment configuration to actually reduce the risk exposure to like a couple of million or something. So that's number three. Project contingency is number four. Basically, any project that an organization has, it is highly likely, and Doug Hubbard is doing a session later today on that topic, which I highly recommend you watching at the Risk Awareness Week website. Doug Hubbard is doing an amazing section because he's basically, he's joined forces with an Oxford Research Institute on project management, and I've butchered the name. I can't remember the exact name of the organization. But basically, they found that you're highly unlikely to meet the project deadlines and the project budgets. And as a result, it's common for projects to have some contingency in place. And the way that contingency is calculated is also should be risk-based, but it almost never is. And that's a very tangible physical opportunity to get involved. We've not so long ago had an interesting situation where we've done the project risk analysis, cost and schedule risk analysis. We've simulated various scenarios and estimated what our project contingency should be. We then had somebody come in externally and say, didn't see that analysis. They came in and they've done their own kind of independent assessment without seeing the analysis that we've done. And they said, well, we actually think you should have, this much contingency. They didn't know how much we designed. They said, oh, you need this much contingency. To which we counter-argued that actually we've done the calculation. This is our model. This is our estimates. We believe that this contingency is required, not this contingency. And they've agreed with our assessment because we've been very transparent about what are the risks, how we're mitigating the risks, and why that contingency is required, and they agreed with our assessment. So that simple fact saved the company more than $10-20 million in the actual cash requirements. So this is a simple report with some Monte Carlo simulations with very direct and immediate savings. So that's number four. And then number five is big one, insurance. Maybe I'll leave that until a little bit later. Fayad, maybe you have some questions in the meantime.
Sure. So you want to take a question from the comment? Is it fair to say top management should move from ARM culture to decision support?
Yeah, so this is thank you, Alejandro, for asking that. I think this is a very fair question, and I mean, not just that. I think it's a little bit more dramatic. I strongly believe that ARM is a complete fraud as a concept, which I know most of your viewers will love to hear that, because their whole career is dependent on ERM. But let's treat me as an alternative point of view, and then maybe it will trigger something in your mind, and you will investigate just in case I'm right. Or you can just dismiss what I'm saying. It's your choice. But yeah, basically, ERM, the whole concept of ERM is just astrology. It's building horoscopes for the sake of building horoscopes. It has nothing to do with reality. Every premise, every artifact that you generate on the ERM is a waste of time. So Alejandro, I don't think it's moving from ERM culture to decision support. I think decision support is the only meaningful way to do risk management. And the quicker we can get out of this ERM cycle, the better. And some organizations are not constrained by the regulators, where they can just say, from today, we're not doing ERM anymore. Like, we're not going to have a corporate risk register with our strategic risks. Like, just forget about that. We'll integrate our strategic risks inside our strategic financial model into the assumption. So, we will do something so much better that everybody will forget about our strategic risk register. So some organizations are constrained. Like, for example, I remember Ministry of Finance issued a lot of publications on risk-based taxation, which was hilarious, because literally what they wanted is the companies to submit like a quarterly tax risk register, which within 5 minutes of talking to our tax department, and this was back in the previous company, within 5 minutes of talking to the tax department, I found out that nobody in their right set of mind will put real tax risks on paper, because they would immediately go to jail if they did so. So this whole thing just became a profanity. But the Ministry of Finance was seriously expecting some sort of quarterly reporting, and even though everybody in the industry knew that this was just a complete lie, just copy-paste some nonsense, they still had to. They were forced to play along with this this game. So not everybody has the luxury of just doing decision support, but I would say that 90% of the time we should really be aiming for the decision support, and then 10% on whatever compliance ERM theater we have to kind of play pretend to keep everybody happy.
Yeah, and this takes me to your principle, which is the 90-10 principle, where you focus 90% of your resources to something that can create value and provide decision support instead of just ticking the box. You want to talk a little bit about that?
Yeah. So that's that's a good point. So thank you for reminding me. This was back in the day when I was the head of risk of one of the sovereign funds, and I was trying really, really hard to make heat maps useful, to make them meaningful. Like, I was looking for different methodologies, because mathematically they make no sense. And just before me, you had a workshop at the Risk Awareness Week, watch the replay if you've missed it, on basically why heat maps should never be used for any kind of risk management ever. Scientifically proven why they should never be used. So it's not an opinion. This is we've knew this for the last 10 years. So this was 15 years ago. I was really trying to find a way to make sense out of ERM. I thought that maybe we're not doing ERM right. Maybe there's like a methodology that would make sense and connect ERM to something meaningful. And then I came to this realization, which in my mind at least holds true ever since, is that there's no way. Like, you just can't turn risk appetite statement into something useful. You just cannot use a ERM framework based on COSO ERM into something that actually helps anybody to do anything, except just create more paperwork and keep the risk management team preoccupied with meaningless work. So I just gave up. I gave up on searching for the meaning in that, and I just parked it, and I called it Risk Management 1. And I said, well, fine. Like, if you can get rid of it, get rid of it. But if you can't, just spend as little time as you physically can. And I call it Risk Management 1. And then I said, well, everything else, the decision support, that must be Risk Management 2 then. And it was actually Mark Powell from US. He's like a risk engineer that used to work with NASA on like truly complex decision problems and modeling risks that never been modeled in life before. And he was the speaker at the Risk Awareness Week for the last quite a few years. So you can catch his replays for free in like 2019, 2020, 2021, and so on. He called it, I think, Risk Management 1 with like small r and like large r. But anyway, I just ended up separating into two concepts. They don't meet. There's nothing in common. They have completely different textbooks. They have completely different methodologies. They have completely different timing. For example, in decision support, you do risk analysis before a decision needs to be made, whenever that is. There's nothing once a quarter. There's no monthly. It's just you have a decision to be made, to be presented to the tender committee on Thursday. That means you have like 3 days to do the risk analysis for that contract before it goes to the tender committee. So whatever the tender committee sees is a properly structured product that already accounts for all the risks. So yes, as a general rule, I'd say Risk Management 1, 10% if you can, and Risk Management 2. That's where the value and the real money is. And this was kind of the central theme of my session today. Is I want to, at least bring to the table the idea that actually risk managers, we shouldn't be shy about how much money we are making and saving for the company, and how much influence we have on the final outcomes, how much better we can structure contracts and investment deals and insurance policies with our risk mindset. Our risk mindset is quite unique because there are not a lot of people that think about uncertainty the way we do. And I think we wouldn't want to waste that opportunity.
Yeah, absolutely. So, Alex, you've saved millions in premiums and helped secure billions in funding. So what lessons stand out from those experiences that any risk leader could apply tomorrow?
So any of the things I've talked about up to now, you can apply that tomorrow. Yeah. So we need to put that idea into people's mind. There's nothing that I've mentioned is exceptionally difficult or complex. Then the final thing that I wanted to talk about is, of course, insurance, because insurance is a cost, and most of the time it's most of the time that these insurances are kind of what's the word I'm looking for? I implied. It's not like we have a choice to insure or not insure. Like, for example, if you're selling on CIF Incoterms, you have to insure. And that's the cost that reduces your profit margin. And it's up to us to reduce that cost to improve the profit margin. If you're building any kind of chemical plant, if you're building any kind of major project, these projects are usually financed. And guess what the banks require? They require you to have construction insurance, property insurance, business interruption insurance, and some liability insurances as well. So many of the insurances are prescribed to the organization. They're not they're not a nice to have. Health insurance is obviously the same. Workers' compensation, whatever is the local your country legislation is. What I have discovered, to my surprise, when the CFO 6 years ago, maybe 5-6 years ago, I can't remember, when the CFO asked me to look into insurance and kind of get it under control, because it was expensive. It was tens of millions of dollars for a very large multi-billion-dollar corporation. So insurance cost is a significant chunk of money that we have to send every year, and most insurances may never kind of pay off in the lifetime of the organization, because they're designed for once in like 200-year event or something. And most of the other insurances, they pay off, but they pay off significantly less than what the actual cost of insurance is. So naturally, the shareholders kind of questioning why are we paying so much for something that doesn't really give us a return back. And when I started looking into this, I again, you always have this imposter syndrome, where you look at, like, you come into the department, you start talking to the head of insurance, and he's very convinced that everything is risk-based, because he has brokers, and the brokers, you talk to the brokers, and they're very convinced that everything is risk-based. So you have to kind of overcome this first realization that, okay, I need to keep digging, because surely there must be something, because whatever they're doing, it doesn't make sense. And then when I kept digging and digging and digging, what we discovered is that nothing was risk-based. Like, it was just insane how disconnected the insurance coverage typically is from the underlying risk profile. What we like, and across the board, starting from, we had a chemical plant insured for $200 million. And the actual exposure scenario was $1.2 billion. So we were significantly underinsured. Then we started looking into, okay, what are the deductibles? Do they make sense? No, they don't. There's absolutely no basis, why we have this deductible. There's no math to support that. Then we started collecting claims data from brokers and underwriters and other companies in our industry. And when we kind of were able to mathematically estimate what would be a fair cost of an insurance policy, we discovered that we were overpaying millions of dollars, and completely unfairly, given our level of control, given our quality of risk. We were overpaying so much because whatever the logic the underwriters were applying, or whatever the logic the brokers were applying, they were completely mispricing our risk. They were basically selling us, they were selling us like this cheap, ugly car, and then charging for like a Mercedes-Benz or a Bentley. And that made just absolutely no sense, because you either get a bad car and you pay a little money for it, or you get a Bentley and then you pay for a Bentley. So these things just made absolutely no sense. And we ended up tripling the coverage, so buying 3 times more insurance, and saved $3 million without even touching the deductibles. So we actually had better policy, more coverage, and paid significantly less. And that just kind of kept happening and happening and happening. So in marine cargo, in property damage, in business interruption, in constructional risk. I remember my favorite story is, I remember one broker, we kept pushing this, risk-based thinking. And as a general rule, the brokers in the industry have no concept of that. Like, they just do not understand what we're talking about. Like, I struggle to find a broker that would actually understand what I mean when I talk about we need to align our coverage with our underlying risk, and we need to understand our underlying risk before that. Because these words probably sound simple, and everybody claims that that's exactly what they do. Well, I can assure you that is the opposite of what they traditionally do. I had one of the biggest brokers in the world come to us and say, we fully understand and we fully appreciate this whole risk-based thinking, and we are on board with your philosophy, and we've spoken to the market, and the best we can do is they wanted to increase the prices by 10%, and we've managed to convince them that they should only increase the premiums by 5%. To which we said, thank you guys, we'll do it ourselves. And we still retain them as the broker for all the admin stuff, but we said, like, you stop talking to the markets, we will talk to the markets. Literally within a month, we ended up saving, I can't remember the exact, I think it was like 15%, which or was it, or maybe like 20% or something. Like we ended up saving, like they were saying plus 5%, we said no, minus 20% or something. But it in dollar amounts, this was equivalent to, I think, $2.7 million within a month of just not listening to the broker and kind of pushing this agenda and explaining, taking the time to explain to the underwriters on what the underlying risk profile is. And that is that is kind of that's a big deal, because we usually, as risk managers, we usually own insurance, or we sit very close to insurance. So it's a good cultural and political kind of example to lead by fixing your house first. Before coming into the operations and saying, we can save you millions on maintenance, it's actually very helpful to save millions on your own stuff, on insurance first, and then say, look, we've already saved millions on insurance. We can apply the same logic, the same format. And everybody's asking me, it's difficult to sell this concept of risk-based decision support and RM2, and to which I'm saying, I don't understand what you're talking about, because when you saved your first million, it is not difficult to sell, the concept of RM2. Everybody kind of begins to get it, because once you started saving millions, it's like it's a no-brainer. You just kind of, let's do that again. So that's the big thing on insurance. And but by the way, I will use this opportunity to plug a little AI agent or multi-agent tool that we've been working on to kind of to help automate some of that insurance thinking and risk profile packaging for better insurance. So I'll share the link in the comments, and then have a look and sign up for like an information session if you are responsible for insurance and you can't figure out how to at least half what you're paying. So just for reference, we, on very large insurance portfolio, we ended up saving between 20 and 30% of the overall cost, annual cost. And on smaller portfolios, we saved like 60 to 70% of the insurance cost. So if you ever feel like saving 50% of your insurance, sign up for this. What else? We have about 4 minutes left. What else?
So what advice would you give young emerging risk professionals who really want to build a career that focus really on decision support and decision impact rather than compliance reporting? So what advice would you give in 2 minutes?
Yeah. So this is super easy, because what we don't realize is that this whole ARM nonsense that exists, the ISO, COSO, all of this nonsense, this is all new. This is less than, 40 years old. This is all new stuff. And risk management existed since 15th century. So risk management has like 500 years of history with tools, techniques, and everything. And then it was basically hijacked by consultants and kind of convinced the regulators in the US that's the thing to do. I'm literally, like, even though I'm relatively young, I literally remember the first time Oliver Wyman came up with the concept of risk appetite. I remember that first brochure when out of nowhere they said, like, oh, risk appetite is the next big thing. I remember that. And that was nonsense then, and is nonsense still. I remember the 98 Australian Standard 4360. that kind of was the the birth. And by the way, if you've missed during the Risk Awareness Week yesterday morning, US time, we had Grant Purdy, the grandfather of ISO 31000, who created it, one of the founders, and he explains very well why they intended decision support, and then it just went completely to risk management one, and they couldn't control it, so they just all got out of the ISO conversation. So advice, very quickly. Because risk management existed for so many years, there are actually proper books on probability theory and decision science and behavioral economics. So read that. Basically, any book that has the word risk in it, except maybe Doug Hubbard's book, which says the failure of risk management, any book that has the word risk management inside the title, it's probably a bad book. I mean, my book is an exception. By the way, it's free. Just Google free risk management book. It's the #1 in Google. And Doug Hubbard's, which is why risk management is broken. So his whole book is why you shouldn't do risk management one, why you shouldn't do ERM. Read the books about the underlying sciences of decision science, the probability theory, and behavioral economics. And that gives you all the tools, all the ideas, all the philosophies and principles that you will ever need to actually do proper good risk management. Kind of go back to the roots. Ignore this fluff about ERM. Go through that and go to the underlying science. Read that, and it has all the answers you will ever need.
Thank you very much, Alex. It's been a pleasure hosting you. It's been a very informative session. I'm enjoying the Risk Awareness Week and encourage everyone to exploit this opportunity. Thank you very much, Alex, for what you're doing for us.
Thank you.